Adam Neumann is standing barefoot in a conference room on the 44th floor of a Manhattan skyscraper. He is holding a tequila bottle. It is 11 in the morning. Around him, 12 of the most senior investment bankers on Wall Street are sitting in silence. They have just told him that his company, the company he built from nothing, is worth less than half of what he believed. Not 47 billion. Maybe 20. Maybe less. Neumann takes a drink, sets the bottle down, and smiles. What those bankers didn't know, what almost nobody knew at that moment, was that the number on the page wasn't the problem. The problem was something buried so deep inside WeWork's structure that by the time anyone found it, it had already consumed everything. WeWork made sense the first time you heard about it. You take a large office building. You divide it into smaller spaces. You rent those spaces to startups, freelancers, small companies, flexible leases, shared amenities, a sense of community. It was a real business solving a real problem. And in 2010, the timing was perfect. The financial crisis had just wiped out millions of jobs. A new generation of workers didn't want corporate cubicles. They wanted something that felt alive. WeWork gave them that. By 2014, it had locations across America. By 2016, 15 countries. By 2019, 528 locations worldwide. The growth was real. The demand was real. But somewhere between the first location in Soho and the 528th location in Tokyo, something had gone very wrong. And the people who should have caught it had been paid not to look. To understand what WeWork actually was, you need to understand one number: $47 billion in long-term lease obligations. That's what WeWork owed its landlords. According to WeWork's own IPO filing, reviewed by the Financial Times in 2019, WeWork had signed leases lasting 10, 15, sometimes 20 years. Legally binding, non-negotiable, payable regardless of what happened next. On the other side of the ledger, WeWork's members could leave with 30 days' notice. 30 days. WeWork was a company that had borrowed $47 billion from landlords and lent it to customers who could disappear next month. In 2018, according to WeWork's own financial filings, the company generated $1.8 billion in revenue and lost $1.9 billion, more than it made, every single year, without exception. According to Bloomberg reporting, WeWork was burning through approximately $200,000 per hour, every hour, around the clock. And yet, the valuation kept climbing. 8 billion, 20 billion, 47 billion. How? If you're still with me, you're one of the few who actually wants to understand how a company losing $200,000 an hour gets valued at $47 billion. Drop a comment below. Who do you think is really to blame? The answer starts in a car in Tokyo in 2017. Masayoshi Son, CEO of SoftBank, one of the largest investment funds in human history, met with Adam Neumann for 12 minutes. According to reporting by the Wall Street Journal, Son pulled out an iPad, sketched out a valuation, and offered Neumann $4.4 billion. In the back of a car, Son later told Neumann, "In a fight, who wins? The smart guy or the crazy guy?" Neumann said the crazy guy. Son said, "You're not crazy enough." What Son saw in those 12 minutes wasn't a real estate company. He saw a technology platform, a network effect, a company that would own the physical infrastructure of the global economy. He saw the next Alibaba, and he wrote the check. SoftBank would eventually pour over $10 billion into WeWork. Each new investment validated the last. Each new valuation made the previous one look conservative. And the higher the number climbed, the harder it became for anyone to say it out loud, that the number was fiction. Adam Neumann understood something that most founders never figure out. In Silicon Valley, The story is the product. If you can make investors believe they're buying the future, the present doesn't matter. So Neumann didn't call WeWork a real estate company. He called it a technology company, a community platform, a consciousness-elevating ecosystem. He invented a financial metric called Community-Adjusted EBITDA, according to analysis published by the Wall Street Journal. This metric excluded marketing costs, design costs, development costs, and general administrative expenses. Remove those numbers. And WeWork looked profitable. Include them. And it was one of the fastest-burning companies in American history. He also personally trademarked the word "we" and then sold that trademark back to his own company for $5.9 million, according to reporting by the Wall Street Journal. $5.9 million for a word, and the board approved it. In August 2019, WeWork filed its S-1 document, the IPO prospectus. For the first time, the public could see the actual numbers, not the story Neumann had been telling. The numbers. What they found was not a technology company. It was a real estate company with $47 billion in lease obligations, a CEO who had borrowed $700 million against his own shares, a governance structure that gave Neumann super voting shares worth 20 times the power of regular investors, and a financial metric that had been invented specifically to hide the losses. Within weeks, the valuation collapsed, from $47 billion to $8 billion, then to less than $3 billion. The IPO was cancelled. In September 2019, Neumann was forced to resign. His exit package, according to reporting by the Wall Street Journal and Bloomberg, was worth approximately $1.7 billion. The employees who had believed in him watched their stock options become worthless. SoftBank injected an additional $9.5 billion into WeWork after the collapse. It wasn't enough. When the pandemic arrived in 2020, the business model disintegrated overnight. Nobody wanted shared office space during a global lockdown. In November 2023, WeWork filed for Chapter 11 bankruptcy. The company, valued at $47 billion in 2019, was worth $45 million at the time of filing. Not billion, million. A loss of 99.9%. In 4 years, and WeWork had never, not once in 13 years of operation, made a profit. In February 2024, according to reporting by the Wall Street Journal, Adam Neumann made an offer to buy WeWork back, more than $500 million. The company he had founded, the company he had driven into bankruptcy, the company whose employees had lost everything. He wanted it back. WeWork's bankruptcy administrators declined. Neumann returned to his new company, Flow, a residential real estate startup that received $350 million from Andreessen Horowitz, before it had a single tenant. WeWork didn't collapse because of the pandemic. It didn't collapse because of bad timing or a hostile market. WeWork collapsed because $47 billion of institutional capital chose to believe a story instead of reading a balance sheet. The bankers knew the numbers. The analysts knew the numbers. SoftBank's own due diligence team knew the numbers, and they wrote the checks anyway. Because in the decade after 2010, the venture capital industry had developed a collective delusion that the size of a story could substitute for the existence of a business model. WeWork was not the cause of that delusion. WeWork was its most expensive symptom. The question isn't how Adam Neumann fooled the smartest investors in the world. The question is what they were so afraid of missing, that they were willing to fund a company losing $200,000 an hour, rather than risk being wrong about the future. Which company are they funding right now? For exactly the same reason.